I'm talking today to Jerome Booth, who's the head of research at Ashmore. Ashmore are a specialist investment fund who look at emerging markets and have 60 billion in funds invested in those markets. Jerome, there has been a shift of manufacturing capacity from the US and Europe to emerging markets. What are the reasons that this has happened?
Well, basically, this is a historical feature, for developed countries, since the Industrial Revolution. I mean, it's a natural progression as you see relative prices of factors of production which come in. So clearly, countries go through a progression, and that's what we're seeing. I don't think that's a great surprise for a lot of people. What it does mean is that increasingly, emerging markets are becoming major producers in goods markets, and not just commodity markets or simple manufactured goods. And that means that because they're also becoming the world's big consumers, that they are actually setting prices in global markets. And that means that as price setters, as someone who's going to retire in 20 years in, say, the UK, has got to realise that the price they're going to have to pay is determined by emerging markets today. And so they need to have their liabilities matched to the emerging markets, and not to have that is actually to take a risk on their liabilities, and that's a concept that we haven't quite got our heads around yet. And
what role does that leave for developed country economies?
More specialist, high-end stuff. I mean, a country like the UK, has been exporting financial services. Our other sort of Microsoft, if you like, is education, probably higher education. And there are, high-level service industries that we have to specialise in. But that does mean, change. It means adapting our economies, and our economies are sometimes less flexible than those in the emerging markets.
And what are the comparative rates of return in terms of investment in developed and developing economies? Presumably the argument is you're getting better rates of returns in emerging markets.
Well, that's an impossible question to answer, by the way.
Yes.
Because, of course, there is huge variability in both developed and emerging markets.
But at high end and low end, let's say.
Well, I don't think there's a simple. You can't drag a number out of me. I'm sorry, but what is clear is that one would expect emerging markets to be growing much faster over the next couple of decades than the developed world, and that's clearly the case at the moment as the developed world is going through their huge deleveraging, which is going to last another few years. And I think the crisis since Lehman's in the developed world, of course, has sped up the shift to emerging markets of production and pricing power, and also, of course, taking market share actually in a very real sense.
And this is something you personally believe in because you're invested in these markets yourself, aren't you?
Absolutely. I mean, I'm very clear about it. But we invest in emerging markets, not in the really high risk places. And that's the whole point. Investing in emerging markets is about reducing risk, not just increasing return. And the big macroeconomic time bombs are in Western Europe and the United States right now, because we had 3 decades of building up leverage in the system, financial deepening. The first 2 arguably very healthy, the third to excess, and it will take a decade to delever, and it's a very
to get rid of that debt, to put it in simple terms.
And the debt levels are much, much higher in the developed world than they are in emerging markets. That's the basic truth.
And what are the main areas of opportunity in emerging markets, and why do they exist?
Well, I think it does depend on your motive for investing. And you see, what I'm saying is that you can be the most conservative investor, and you need to be in emerging markets to meet your liabilities. So the obvious first thing, if you're really conservative, is to invest in cash, only in cash, which is in a safe currency, or actually not one, but say 30.
Yeah.
The currencies that are going to appreciate because of global rebalancing. So that's local money markets, which, by the way, is a $9 trillion market, massive market, very diverse. That's the safest place to go. If you then move away from that, within fixed income, obviously there's sovereign bonds, both denominated in local currency, but also in dollars. Corporate debt, which with some very reasonable assumptions, could yield you 19% in the next year.
Yeah.
Looks highly attractive and much better credit quality on average than their equivalents in the West, and of course not subject to highly correlated downside risk. And then you've got sort of equities as well, which of course when they rally is going to have outperform probably everything. And then there are real assets. So there's a whole range of different asset classes, and I think the simple answer is I wouldn't choose one. I would basically be wanting to put 50%, if I'm just sort of neutral, of my entire portfolio in emerging markets, because it's 50% of economic activity on the planet. And to do that, I need the range of the whole thing. You know, I'm not taking emerging markets just because it's some sort of speculative bet to add on to my core. No, this is core.
This is central.
And within emerging markets, there's every asset class that you could want.
And what is the best opportunities in emerging market debt?
Well, if you ask me, well, what's likely to do the highest return over the next year, it's between corporate debt and local currency. Local currency debt is likely to appreciate simply because the currencies are going to go up. Now, if there's global rebalancing, if that really starts in a serious way, that could be very significant. But barring that, you may still have a sort of 15% sort of move. So that's comfortable. Corporate debt, though, is more certain to do a sort of just below 20% sort of return. I mean, that's with reasonable assumptions. I mean, these are not predictions, I understand.
Ones, yes.
But just assuming certain amounts of spread compression, etc. So probably corporate debt. But if it looks like we're starting to see big foreign exchange movements, then you want to have local currency debt.
What about, we've seen an enormous economic slowdown in the developed world, but this in a sense spirals on into developing countries, doesn't it? If we buy less trainers, the Chinese buy less oil, and it goes round in a circle.
Yes.
Africa's growth rates have been 5 to 11% at the top end. Surely there's a danger that if we buy less, then they will do less.
Absolutely.
And therefore...
But that everything's connected.
Yes.
One of the really things I object to is this idea of decoupling. It's a very simplistic and misleading idea, and it's a form of what I call core periphery disease.
Yeah.
And I call it a disease because it's a deeply seated meme in our heads.
Yeah.
And basically the core periphery idea is that the core affects the periphery, but we can ignore the effect of the periphery on the core. And that's actually not the world we live in today. The world we live in is 50% of economic activity on the planet is in emerging markets. And of course everything's interconnected.
So the periphery is no longer the periphery.
No, it's not.
Yeah.
And what I would say, if you think about the sort of decoupling idea, it's simply that, if I've got a problem in the United States or in Europe, then of course it must be worse in the risky places, which is of course a misconception of risk, because risk is not a linear thing. And therefore I sell the emerging markets.
Yeah.
Now, if you actually think through scenarios, though, the worst scenario globally, by far, is depression in the United States and Europe. Now, the last time we had depression, net investment in the United States fell 95% in 3 years. Unemployment went from 3 to 25% in 3 years. It hit 50% in urban areas. Growth did not recover from 1928 levels until 1941, and that was because of the war. Oh, and we had a war. This is a hugely negative scenario. If we had depression again, we're talking about hundreds of thousands of companies going bust at the same time across Europe and the United States, and that is a significant risk today because of the amount of deleveraging. If that happens, there is no way emerging markets escape. They are going to be severely damaged. In fact, so badly that in fact the average growth rate may go all the way down to 5 or even 4.5%. It's that bad. Now, when I give you those numbers, you realise immediately that yes, of course it's connected. Of course it's negatively impacted. But you certainly want to be there because it's much better than being in the crash zone. We have to challenge the way we think about risk. Risk is not volatility, it's large permanent loss. And all the large permanent losses which are really significant are right now in the developed world, not in emerging markets.
And the other big core periphery shift is currencies. And clearly what happens when the Chinese currency becomes a tradable currency that effectively can be used for trade and for investment and so on and so forth.
Again, there's, I'm afraid, a big story behind this. We have a monetary system globally which is prone to imbalances. It was established with the Bretton Woods Conference in 1944. Keynes argued for a more balanced system. He was overruled by the US Treasury. And we ended up with a system which suffers from what's called the Triffin dilemma, which is that basically the United States is central bank to the United States, but also to the world. And that means if the world demands more dollars, the central bank has to print more dollars, otherwise the world stagnates. And the problem is they print the dollars into the US economy. And to get those dollars into the global economy, you typically build up imbalances. And the US debts build up. if it's not growing at the same rate as the global economy, or for whatever reasons they're not balancing their fiscal positions. And we've had this for the second time now. The first time that the whole system blew up was in 1971, and the dollar devalued from $35 an ounce to, by the end of 1974, $195 an ounce. That is a serious devaluation.
That's in gold.
In gold. Yeah. Now, the point is, that is the sort of dramatic shift that we might see in currencies. We have, just like in 71, huge surplus central banks on one hand, all of them in emerging markets apart from Japan. I mean, emerging markets own the vast bulk of international reserves. And it's their decisions that will drive currencies, not the United States, because the United States has no reserves to speak of. And this is the whole point. It's not merely that the emerging currencies go up when this rebalancing occurs, it's the fact that it's their central bank's decisions which drive the whole thing. And the question is that going to be done in a panic, in a sort of prisoner's dilemma, rush for the exit, or can it be coordinated or done gradually? One hopes gradually, but to do that we need to have a change in the reserve structure, and this is where China particularly is important because it's the largest reserve holder. And I think a lot of other central banks are sort of waiting to see what China is doing, because central banks tend to be, in my experience, very, very intelligent people, but they tend to like to follow each other.
Yes.
And as we all do.
Yes.
And I think what we're looking for is some signalling. And I think China's very, very important here in a leadership role. And we do need to move to an international reserve system which is much more balanced and in tune with the real economic weights in the global economy. And that means not going from the dollar being the dominant currency to one other currency. It means going to a multi-currency system which reflects the true international trade and economic patterns in the globe.